Hey, round 7 in the bag, in the books. Write it down. We are on to the final round. Um, in an 8-round battle, I'm with 6 contestants in the ring. I'm happy to report that it looks like at least 4 of those contestants might still be standing at the end of the fight. But I'm not going to say that for sure. We will look at the data a little bit and try to determine how things are shaking out. Let's first look at the assignment for round 6 and what we came up with there. I kind of just perused your guys' answers, so we'll go through it here. It says, how much did Digby leave on the table in the low end? Please calculate in units, sales, and before and after tax profits. And it looked like a couple of you did well on this, went through it, and obviously saw it the same way I did. I didn't deal with days, and you could have, and that's fine. I'm certainly not going to deduct if you did. Days actually added back because their actual exceeded their potential. But Dell left on the table 13.1% of the market. And as I was looking through, most people kind of got that. After that, kind of got goofed up. Some people took that 13.1% times Dell's sales versus the total market sales. And that's because this is their potential of the total market. This is what they actually sold of the total market. And so you have to take the 13.1% times the total market, which was 17,414,000. So what they missed out on was selling 2,281 units. Their price was $13.50, or they missed out on 30,796,659 in sales. Take the same units times their marginal cost per unit. That's the cost on the last unit that they made. Kind of going back and figuring that all of these were made. I'm sure they were in this year. Okay, or would have been, I guess. Yeah, that's the ones they missed out on. So they would have been made at this marginal cost. And that was $11.53. That's just combining the material cost and the labor cost. So the variable costs per unit were $26,299,930. So before tax would just be this minus this, and you would come up with this would be their before tax income. And then we got to calculate their tax, right? Their tax on this, their tax bracket's 35%. So their tax on that would be $1.5 million, roughly. And so ultimately then their net income would be $2,922,000. And I saw the couple that got it right, they might have rounded a little differently, and a few bucks off, that's no big deal. We're not going to worry about that for sure. So, okay, so that took a very 1, 2, 3, 4, 5, 6, 7 steps for me. None of the steps difficult, but keeping them in order and doing them, in that order and doing them correctly each time is ultimately important to getting that final answer. So. Number 2, Erie made about $28 million more after tax than Ferris, and why or how. And the first thing, and most people, as I perused these, got this part right. They had a lot more in sales, obviously. I need to see if I'm on the right. If I'm on round, I'm on round 6 here. So they had a lot more in sales, and that's a huge factor, obviously. Yeah, that makes it too big. I'm sorry, I was trying to make it bigger, but go back to that 175. $327 million in sales versus 272. So, that's $55 million more in sales. So that's huge. Would I put $50 million? But it'd be $55 million. Okay, this is the one that most everybody kind of missed, and it's one I've been stressing. I think all semester is contribution margin. Okay. And I don't know why. I mean, that one's really obvious, 41.3 versus 29.9. And here's where that really shows up. Let's come down here, okay? Now on, where'd I go? On $327 million in sales, Erie had variable costs that were $192 million. Okay. On $272 million in sales, Ferris had variable costs that were $191 million, so $191.3. I mean, that's a dead heat right there on the variable cost, and yet Erie had $55 million more in sales. Well, how did they accomplish that? How did they sell that much more and yet have variable costs that were the equal to, basically, of Ferris? The answer is the contribution margin, right? Or you could say their cost of goods sold, which is the inverse of the contribution margin, right? I mean, their cost of goods sold is roughly 70%. Their cost of goods sold is roughly 59%. Okay, huge, huge, huge difference. Saying it another way, if I did the math, and I don't know if I did the math on my deal, yeah, 37.3 million. So let's go back and I'll show you where that would go. Saying it another way, if Erie had the same contribution margin as Ferris, its variable cost would have been $37 million higher. Its variable cost would have been 229, but 230 million roughly. Okay, and so that's the huge factor. I mean, granted, yes, the sales are the big factor, but then you take that variable cost and you reduce it like they do, thus enhancing your contribution margin, $37 million difference. So that, that's one that needs to pop off the page at you every time you look at that. Now, when you're looking at financial statements in the real world, if you're analyzing a company or doing some such thing, look at gross profit. Okay, that's going to be most often similar to contribution margin. Okay, because that's what gross profit is revenue minus cost of goods sold, and that gives you the gross profit. Okay, or gross, and if you're looking at it percentages, okay, that gross profit, your gross profit margin based on the sales, and it'd be very, very similar to the contribution margin. Okay, and so it's very comparable. Okay, and then additionally, Erie made about $3 million, or had about $3 million less in interest. Many of you pointed out, and appropriately so, that some of these advantages were offset by some other things that Erie actually spent more on. They had more depreciation, a few other things, and that's fine. I'm glad you did that. Okay, question number 3: what was the after-tax cost of Digby's investment in TQM? And this one, I don't know why it would have stumped quite a few people, but the total investment that they made was $10.5 million. Now, they get to deduct that $10.5 million because this is a direct expense. They get to deduct that from their taxable income. Okay, and so that's going to reduce their income tax by whatever their income tax bracket is or percentage is. Okay, and in this case, in this game, it's 35%. So their tax savings is equal to the $10.5 million times the 35%, or $3.675 million. Okay, and so when I take the $10.5 million, that was the actual check that they wrote, but when they get basically a discount on their taxes of 3.675, their after-tax cost becomes $6.825 million. Okay, just wanted to demonstrate there, and believe me, in business, this goes through your head all the time. You're constantly thinking of your marginal tax bracket. If you're not, you're crazy. Okay, you need to constantly be thinking of your marginal tax bracket when you're making those types of investment decisions, because it's absolutely huge. It's why a lot of times you see businesses, especially like farmers and ranchers, that might have very good years and very bad years. In very good years, they're often looking at ways to reduce their taxable income, and they'll do that by buying items that they can expense, prepaying maybe, for example, fertilizer, or prepaying some of those types of bills so that they can save tax dollars, right? Some people would say that's deferring tax dollars, but that might be another whole class if we talk about taxation. I think Rod teaches that, so we'll give that to him. 4, how much did your team save last round in labor costs due to your cumulative investment in TQM? So a lot of you, it looks like you did okay on this one. Some of you made it way more difficult than what it should have been. And when I say okay, none of you calculated it the way I did. I'm probably not gonna, I won't discount you for that, because I understand why you calculated it the way you did, and that's how I would initially probably have done it. But given it more thought, I did it a little another way. But Erie, I chose Erie just to take a look at it because they're a team that didn't have to do the Chapter 6 or the Round 6 assignment. And they had 11% labor cost reduction. Okay. As we can see, if we scroll way down to the TQM, 11% labor cost reduction. Okay. And then for you guys, yeah, let's see, I'm in the right, so I'm going to go to reports, and what some of you didn't do was just come to your annual report. Some of you actually did a lot more difficult math, and you may well have ended up with the correct answer, but this would be a lot easier. If you come here and you come to the annual report, you got the balance sheet, the cash flow, and the income statement. It's direct labor cost for, I'm looking at Digby. I would have to go back and change into another team. And I'll just show you on here, and then I'll go back. But the direct labor for Digby was $47 million, and for Erie is something else. We'll go back and take a look at that. I've got it written down on here. I'm sorry, $68,568,000 was Erie's cost. Okay, and the actual labor cost divided by 1 minus that 11%. Okay, you all took the 11% times this. It's actually going to get you pretty close, and the smaller your labor cost reduction number, the smaller the percentage, or the closer you're going to be. But technically we divide it by 89% in that case, because we're actually the savings, at least I'm assuming that that's how it's calculated, the savings would have been on the initial amount, right? You'd have had an 11% labor cost reduction. So if you took 11% of this amount here, this $77 million, you'd end up with $68,568,000. Okay. If I took this times 11% and then added it to that and multiplied that by 11%, I'd actually end up with something a little smaller than that, or 89% is what you'd multiply it by. So it's I'm sort of kind of splitting hairs, but if we were getting really accurate, that's how we would want to do it. Okay, what labor cost would have, that's what the labor cost would have been without TQM is $77 million. But its labor cost was actually only $68 million, so they had about an $8,475,000 labor cost savings. And obviously, everybody's answer is going to differ. And like I said, I'm not going to discount you if you did the multiplication, but I hope you understand, how we should actually do that versus multiplying that. So. Okay, that was chapter 6, so, or round 6. Why do we keep calling chapter? I guess that happens sometimes. So, let's go on then to round 7 and see what happened. I don't think it's going to come as any surprise about which team probably won. I think the only thing that might be a surprise is if they got a perfect score or not. So, yeah. One team is at least living up to my prognostication that by the end of the competitive rounds, usually I see at least one team throttle the computer team. And so, Erie, thank you. You guys are living up to that expectation and that prognostication, because you certainly, this round at least, destroyed Ferris along with your other student competitors. And I'm going to make a bold prediction here. My bold prediction is that this is Erie's game to lose. Okay? By that I mean it's going to take a pretty good screw up on their part. Okay? Or I'm going to tell you, though, that there's at least one tactical opportunity available in this last round that could make a profound difference. Okay, if that were done in conjunction, if a person took advantage of that tactical opportunity with a lot of the other tactical opportunities that you might normally take advantage of, okay, but there is one that would require a little bit of pencil lead. You know, you might have to do a little bit of calculating. God forbid we do some calculating, but it has the potential to be a huge opportunity that a team or teams could take advantage of. It's not, it wouldn't be restricted to one team. It would be available to all teams. Anyhow, ROE, wow, 36.3% happy. I mean, Digby 7.3% would make me relatively happy. We got 3 emergency loans. That's ugly. Okay, and sales we see. Look at that, 418 million for Erie, 100 million more than Team Ferris, which was second place, more than Chester and Digby combined. You know, so pretty impressive sales for Team Erie. Okay. And obviously then quite a bit more profit, 62 million. Looks like, in fact, quite a bit more, twice as much profit actually as all the other teams combined, even if you don't count the negatives for Andrews and Baldwin. You know, if you just take the positives for Chester, Digby, and Ferris, and Erie had twice as much profit as all of them combined. So pretty impressive, you know, fairly impressive. It's, again, what I expect, though, by the end of the rounds, is for it to be that impressive. So stock market, you know, no surprise here. Earnings per share, huge, you know, huge earnings per share. They paid a little dividend, and as did Ferris. Ferris paid a pretty big dividend, and of course the stock market report looks like that. Erie was not afraid to borrow money. Good for them. Again, if we go back, and since it's now the end, you know, everybody sold stock, and in fact Baldwin was still selling stock, and I cannot think of anything I would rather not do in this game than sell stock. If I were to sell stock, again, I would only do it in the very first round, and I would only do it if I were going to make massive investments in that first round in things like automation, where it's available in the first round. You know, TQM and some of the other potential investments wouldn't be available. You certainly wouldn't need any capacity in the first few rounds because you got excess. I would probably sell, and we can kind of go back now, and I'd tell you I'd probably sell capacity in the first rounds and take that money and invest it in automation. Okay, that would be the only reason that I would sell any stock in the first round, and even then I probably wouldn't, and I would only do that after I had borrowed every penny the game would let me borrow. Okay, and why would I borrow every penny first? The answer is because debt's always cheaper than equity. Would I have a bad leverage, bad working capital, all of the above? I'd get dinged. I would lose the first round horribly, maybe the second round. Then after that, you know, based on what other teams normally do, it'd be pretty clear sailing. So cash flow, you know, here, dominant this round and with a foot on the neck. I like it. Erie has, you know, not only just completely dominated round 7, I'm sorry, but they've still invested $54,300,000 in plant improvements, and at this point there's not a lot of need to go and look at what it is. It's looking like they had to increase their capacity a decent amount because they understand the dynamics of the growth that's happening in the game, and probably still invested some more in automation. Now, automation investments at this point would their payback would probably be insufficient, if that makes sense. It probably takes a couple of years to get a payback for automation, and so it's something that's done far better or with more confidence early in the game. And again, you know, when I say this is what I would have done, you have to remember I've had 5, 6, 7, 8 years probably of looking at this game, and so I can't say that's what I would have done if it was the first time through, like for you guys. But having been through it, yeah, I would have made those types of investments. good cash management for Erie too. Look at that. You know, you don't want to be cutting it too close, but you also don't want to have 70 million or 67 million like Ferris does, right? And that's a nice number. I mean, I can't tell you that that's too high or too low. That's just a nice number. You know, there's a decent cushion there, okay? And yet, look at that. They were able to pay off some long-term debt, pay down their current debt. They didn't have to borrow any more current debt because, well, when you make $62 million, that happens. And they invested that $54 million. So, I mean, wow. So they did a lot and ended up with a good positive cash balance. It's not too much, not too little, right? Okay. Huge company. You know, they've grown their company. And in capacity and whatnot in anticipation, but it's because it's because the competition has allowed itself to be buried. I hate to give Erie all that credit. You know, oftentimes when one team does excel, it means that it's that other teams have allowed it. You know, that type. You know, would they have 418 million in sales if the other teams were competing, you know, head to head really in some of the areas? And yeah, okay. So we come down, you know, again, we look at some of the same stuff that's going on here. I don't know in particular anything in here. I'm impressed that, you know, Digby's investing some more in TQM. That's great. Again, in round 7, the payoff starts to diminish. Okay, the total payback that you might expect starts to diminish. Now you're going to get a nice payback still in 7N in round 8, and that could be extremely meaningful, right? Yeah, you know, still lots of excess capacity for Andrews and Baldwin, and you see Erie just stretching out. I mean, they've got capacity now for over 16 million units, so that's pretty impressive. You know, Chester and Digby are using their capacity for sure. Ferris kind of ended up with a bunch of extra capacity. I think they've pulled in their horns a little bit because of the competition that they've gotten from Erie. You know, glancing down, I see in the low end, everybody sold out. I don't know if we met demand in the low end. That's going to be important to look at. And we see over here some of the contribution margins, you know. Andrews actually, it looks like they did a pretty good job of bumping up their contribution margin some, and they also did a nice job of getting rid of some inventory. They had just dug themselves a deep hole. They're having a tough time getting out of it. But they've actually, in the last round or two, done a decent job. They've at least stopped digging, right? Baldwin, a bit of a hold, a bit too much inventory in a couple of areas there. You know, it'd be important to look at. That looks like a really old product for the high end. Might be some stuff that was in inventory. I'm not sure. Digby, a little too much inventory. Probably why they had an emergency loan, because they did have a little too much inventory. Erie, perfect. You know, maybe not perfect, because they probably stocked out a little bit here. They might have had some other opportunities there, but you know, not a ton of inventory, but not too little really either. Huge contribution margins. You know, they got a couple of them here that are below that 30%, and the looks like both in the performance end. So kind of interesting that those would be the ones. Cluster, you know, not really a cluster. That's kind of spread out actually for the traditional segment. And I'm going to cruise through. We don't see a ton of actual versus potential. You know, look at there. Digby could have dominated. That's an interesting thing here. Was it Digby we did last round that we were looking at their potential versus actual? You know, the actual was 15%, and they had a potential of nearly 35%. So they lost out on about 20% of the market, or you know, about 3.5 million, let's say, units. And you know, what's Digby selling those for? 13.5, which is really cheap, but that's why they have that kind of potential. Okay, is because of their price, because price being the number one thing. So they could have sold just, you know, another $50 million worth of that. Now, that said, what they really want to do is get that contribution margin up, though. You know, look at the difference here: $2 in labor cost and $5.29 in labor cost. Okay, 535 in material cost, 478. That's 60 cents. That's all right here in the MTBF. So okay, it might be a couple other things, but because it could be TQM and some other stuff. Although Digby's probably spent more in TQM actually, but my guess is it's a lot of it right there in that MTBF. So you go from a 55% down to a 20%. And part of that's price too, right? Because they're 13.5 versus 15.25. So even if they added $1.75 to that, they'd jump up that contribution margin probably 10% at least. Okay. So some discrepancies there. High end, everybody kind of performed, where they were. Again, you really see Erie and Ferris have done a nice job of clustering themselves out here. Dixie picking up a little bit of scraps, and Baldwin, picking up some scraps there. Very similar here in the performance. Probably similar here in the size. Yeah, quite similar there. So. And the other team's just picking up a few crumbs here and there. So perceptual map, we kind of saw that up above. Yeah, kind of interesting here how spread out that is. Oftentimes I see it get kind of clustered in the traditional. I think that's how we were in the practice rounds. But it's kind of spread out here. You'd think that Chester, and I think they did dominate the traditional. Again, they got 4 products in there, so that would be expected. HR, look at that, 121, 122% productivity. So huge increase in productivity, and you couple that then also with some of the, labor cost savings, et cetera, just huge. Okay, and we talked about the R&D cycle time. That's what has enabled, because they were behind, if you remember, Erie was behind Ferris big time, but they've been able to make some big jumps, leaps and bounds, okay, in this category because of the reduction in the cycle time. Okay, so that's kind of a quick overview of that. That's good. Now we got to go take a look at next week's assignment and the winner. Like I said, I don't think the winner is of any surprise, but okay, assignment for round 7C. Let's explain this a little bit. For round 7, Erie produced more than twice as many units, and I had to go calculate that because I can look at your guys' production and whatnot. That's probably not, that part is probably not something you'd be able to figure out. So just take my word for it. Erie produced 18,736,000 units, and Chester produced 9,200. Yet Chester, had only 145 more employees. So Erie, let's go take a look at what I mean here. Okay, the production side, you have to take my word for it, but based on the sales, you can kind of guess that, right? I mean, Erie had sales of 418 million versus Chester's 182 million, so way more than twice. Okay, way more than twice that they produced, and yet when you come down here and you look at their employee, the complement and what they need, Chester had a complement of 1,080 employees, and Erie had 1,225, so only 145 more. 12, 13% more employees, and yet about 130% more in terms of sales revenue and production, about 100% more. So a 10 or 15% more employees for 100% more production. Why is that? Why was Erie able to accomplish that? How are they able to accomplish that? And yes, I know my grammar there is incorrect. Sorry. 2, what is the combined total capacity for the low end segment for the final round? We've had that before. In this case, there is no inventory. Everybody's sold out. I think I meant to show you that, and I didn't. But if we cruise up here, that's got to drive you guys crazy when I cruise back and forth like this and do it kind of quickly. Sorry. But in the low end, yeah, we were close. No, we weren't even close. Okay, the total demand was 19.5 million. Total production or total sales was 18.5 million. So we came 1 million units short as a group. Okay, and that's kind of important, and it's going to grow 11.5%. So, there's going to be another 2 million roughly on top of that. So there's going to be a need for 21.5 million units next year. Okay. And you guys need to calculate the capacity, keeping in mind that you can use both shifts, right? Sorry, then I got to go to the next question. I'm sorry. What are the effects of purchasing common stock from the company perspective? So be specific, e.g., does it affect cash, etc.? Kind of general question, but I want you to look at it and be kind of specific, right? When we make a decision to buy back stock, okay, purchase stock as a company, okay, remember I said I would never, probably never issue stock, for sure past the first round, and probably in the second round, if I could, even if I had to borrow money, I would, to buy back stock. If I were playing the game, I'd buy back they only allow you to buy back so much, and I would be as aggressive as I could throughout the whole game and try to reduce the total number of shares that are outstanding because of the effects that has, and I want to know some of those effects. Now, what's it going to do to cash? I'll give you a hint, okay, so you can get part of the question right. Your cash is going to go down, right, because you're going to have to spend money, okay, but how does it affect things like your equity then? How does it affect some of your ratios, your profitability ratios, and those types of things? So try to think that through. And the same thing with dividends, okay? And you have to think it through, okay? You have to think it through. Go look at all the statements, you know, the cash flow, the balance sheet, and the income statement. Think about how it might have an effect, and even the stock market or the stock statement up there, you know, how it might affect some of those things, you know. Another obvious one, so here's two. You're going to have less common stock outstanding, okay? What are the effects of paying a dividend? Same thing, you know, try to be specific on that, okay? And give me, you know, some of the different categories. And again, you might go take a look at your various statements. Now, here's one that it does not do, okay? Paying a dividend has no effect on income. Okay, because dividends are paid after tax, so it comes out of the after-tax income, and it really has no effect on income. So please don't put that in there, that it affects income, because it does not, right? It's not deductible, it's nothing, okay? It has no effect on income. So there you go. I gave you a few answers. I gave you a couple answers for that and one not to put for that one for sure. Think them out, you know. Hell, Google it. I don't care. Look it up. I just want you to know the answers, right? I think I'm done. I think, you know, I made it a little over half an hour, got through it. You know, next week, if I do a final report, it'll be a really quick one. You know, I'll send out who the winner was, of course, and I might do just a quick little video. So what it is, you guys still have the CompXM to go. I don't know how many folks have how far they've come along on that. And I don't, if I look at everybody be able to see, but I would guess that folks aren't done yet. Okay, so please make sure that you get after. I'll check after this, and I might have to send out some individual notes if you're not making some progress on that. But please don't wait till that last week. It is fairly intense. Okay, it does take a fair amount of time to do a decent job. Okay, people worry about their grades on it. Here's my deal. Okay, I need to know that you did your best on there. Okay. And so somebody who's a reasonably good student who gets a really, really cruddy grade on that, I kind of scratch my head, okay? You're going to get an okay score, don't worry, as long as you do your best, okay? So there's my criteria for grading that. Is that a little bit subjective? Yes, it is. But I don't think you'll be disappointed as long as you put a really good faith effort into completing that thing. So please do that. All right, with that, why'd I go there? I don't know. I guess you guys wanted to see that the stock market was up 168 points today. Cool. So you guys, I'll talk to you next week, probably briefly. Send out a note at least. Bye for now.